Hello Sector Watchers, welcome to the show. This is the 195th episode of Sector Spotlight, part 2 for Wednesday, the 1st of November. My name is Julius de Kempenaer and I am presenting to you from Amsterdam in the Netherlands. As it is the first day of the new month, it means that we have completed monthly charts for the month of October, and that is exactly what we're going to look at. Ladies and gentlemen, this is Sector Spotlight. Let's start with the rotations for asset classes and see if we can find any major takeaways from this image. Here's the RRG for the asset classes as we're usually using it here in Sector Spotlight. And immediately there's one tail that catches the eye, and that's the Bitcoin tail. Unless you have not followed any news, you have probably seen and noticed that there is a new move underway in Bitcoin. It took out some major overhead resistance levels, and that is what is now starting to show on the longer term rotations as well, because this is a monthly RRG, so this is looking at really long-term rotations. That is a good sign for Bitcoin. So from an asset class perspective, Bitcoin is definitely worth a look and maybe a small holding in your portfolio. By the way, Bitcoin is used as a proxy for cryptocurrencies in general. To get a better picture and a better use of real estate, I'm gonna toggle this tail off and center my chart, well, fit my chart and make sure that we can see all these tails better. And I think that the main takeaway from this rotational picture is still that SPY stocks are doing well. They rotated back into the leading quadrant despite the weakness that we've seen over the last couple of weeks in the stock market. This rotation is telling us that the longer term relative trend for the stock market is still in good shape. And the opposite is true for the fixed income rotation. So you got corporate bonds, government bonds, and high yield bonds. They're all moving into that lower left-hand corner. High yield is doing that from the leading quadrant. Government is already in there, and corporate bonds are rotating back towards the lagging quadrant while they are still inside improving. Keep that in the back of your mind. Then two other tails are the commodity tails, DJP and GSG. They came through leading and then had a long rotation through weakening, and they're still not in the best of shape from a longer term perspective, but as you can see, they're picking up slightly in terms of relative momentum, and that is something that I want to keep an eye on. And then finally we've got the US dollar tail, which is inside weakening, and it's starting to move higher slightly, still moving to the left on the RS ratio scale, but it's starting to move higher slightly. And this could actually be a rotation that is completely completing inside the weakening quadrant, so to the right of the RRG chart. And we know that that would be a very strong sign for the US dollar as a whole. So this is starting to point to renewed US dollar strength. Now let's take a look at the individual charts for those asset classes. I'm going to save the SPY chart for when we talk about the sector, so I'm going to start with government bonds. And this is a pretty disastrous chart, I've got to say. The break last month, and I'm sorry, I was on a hiatus, so it has been 2 months now since we spoke about the monthly charts. And you can see that that break was already imminent last month. So, and it's got a follow through now. So government bonds in general are on a weak streak, pushing yields higher, and I think that this is the most dangerous chart for the stock market. If this trend continues, then the stock market could get into real trouble. It's in a little bit of trouble right now, but then it could get into real trouble. I'm not ready to call that yet, but I'm absolutely keeping it in the back of my mind. If you look at IEF, has a little more, so GOVT is the entire yield curve, IEF is only the segment with maturities between 7 and 10 years. And if you look at this chart, it's got the same sort of break that we saw in GOVT, but you can see because there is a little bit more history that we're approaching, I'd say, a pretty significant support level. This has been a resistance area in the second half of the 2000s. Then we got the break in 2008, and then we rallied 2009. We got that now back as support. These levels have been respected pretty well over the past. So I'm actually looking for support for IEF around 88. It means that there is still a little bit of downside left for government bonds, but we're getting into an area where historically support has shown up, and that would mean the end, or at least a pause in the rise of interest rates. We go to corporate bonds, we see a similar picture. We didn't see the real break below the previous low, so we're holding at support here. So government bonds are, if you wish, a little bit ahead of what's happening in government bonds. Still at risk. I mean, it's very clearly, so the low here was 98.40. If we break below 98.40, that's going to be at a monthly closing basis. So there's still way to go. That's a couple of weeks out. Nothing indicating that that's going to happen, but 98.40 is the level that I'm watching for corporate bonds. If that breaks, then we probably get some follow through in a negative sense for corporate bonds as well. And then we have high yield. That is, out of these three, probably the worst chart, because it's breaking out of what can be seen as a small consolidation pattern. I probably should have drawn a small falling trend line here indicating a triangle. Let me do that right now. I'm going to pause this video and draw that chart. So here's the annotation as it should be, I think, and you can see how last month we broke out of that triangle, out of that continuation pattern. It's a symmetrical triangle, can very well be a continuation pattern. Question is, how much lower can HYG go? How much lower can high yield bonds go? I'm looking for 70 as the first support level, but you can see it's only one low here. There is more support. I always have trouble with these types of spikes down. However, in this case, it is lining up with sort of the middle of this wild period here in 2008 and 2009. Not very clear, not very accurate probably, but it gives us a little bit of guidance, and that's all we can use for high yield bonds. For the time being, it's in line with GOVT, it's in line with LQD, and it's pointing lower, but getting closer to a major support level. So maybe this is the last phase of the decline in these fixed income bonds. Now, commodities, after kind of getting out of the doldrums back in 2021 and showing a very good rally in 2022. 2022 and the start of 23 wasn't the best of periods for commodities. And to be honest, if you're a regular on the show, you will probably remember that I thought it would pick up earlier. That didn't happen, but it looks as if we're getting there. That decline stalled at the former resistance level, so that's a good thing. Former resistance turning back into support, and you can see that we're actually breaking that trend channel that you can draw from pretty much a year ago, and we're now pushing against overhead resistance that has been built up around 33 and a half. So for DJP to take out 33.50 on the upside would be a good sign and very likely signal a further rally to the next resistance levels, and I'm going to say that's going to be 37 and a half, and then obviously here just above 41, that major level that is the peak area that was set here in May 2022. We will get a similar picture in GSG, long base breakout, correction, pullback, which took a little longer than expected, but here also former resistance took its role as support. We're breaking that down channel and we're now pushing against resistance. So not as pronounced as it was in DJP, but I think that when GSG is taking out its last high here, that's 22.95, so rounded off at 23, you will see a further rally, and obviously there is much more upside. Look at the history here where commodities have been trading in the past. That is all very much possible if this improvement continues. Now we go into the currency area. So here's the US dollar. This is the long-term chart of the US dollar index, and again, this is also we had the rally, we were watching this decline and expecting the 100 area to act as support because it was such a heavy resistance area. And then all of a sudden, back in July, we started dipping below it, and it was like, you know, this is not very good, we're going to get lower. But that reversed, and that's why it's so important to keep a little bit more of an open mind to the longer term picture and respect that those moves are not necessarily tied to a single level. They're way more tied to ranges, to areas. And despite the fact that it scared me as well when we dipped to 99.22 in the dollar index and comparable levels in the euro dollar chart, but we bounced, and I think we can now safely say that 100, support at 100 held. And the last month, well, this is all because it's 24-hour market, so this is already starting its new month. But we are taking out the 105.87, 106 peak, which means that we're getting back into the uptrend. So all of this is pointing to new strength for the US dollar. And if you look at the RRG for currencies and some of the individual charts for the euro, for the dollar, like euro dollar and dollar yen, you will see that strength is definitely getting back on the cards. And then maybe not a currency, but an asset class, cryptocurrencies. Here is Bitcoin, and after a pretty long period of doing nothing, well, nothing is very relatively speaking, because moves between 15,000 and 30,000, that's a 100% gain or a 50% decline. They're very major, but if you look back in the history of Bitcoin, it is a whole lot of nothing. Well, a little bit of nothing. But what's more important is that we are now taking out, or we have taken out, I'm pretty confident that we have taken out that overhead resistance area that had been building up for a long time around 30,000, 31 and a half, a little spike to 32, but that whole area around 30, 31,000 was getting more and more of a resistance area, and all of that supply has now dried up. There's no supply anymore. That's why the demand was able to push Bitcoin so much higher so rapidly. And it also means that that former resistance area can now be expected to act as support in case of a decline. What it definitely means is that the chart for Bitcoin has now shifted back into an uptrend. And as you know, those can be very vicious. So the first level that I'm actually watching for Bitcoin is the high here that was in March, and that's 48,000. We're currently trading still below 35, sort of 34,400 as I'm recording this. So that's still a very decent level or upside potential, I gotta say, for Bitcoin. And then finally, I want to point your attention to the SPY IF chart. I talked about that in the regular episode of Sector Spotlight not too long ago, and I pointed out how on the weekly chart you got that double top formation that was broken, and it looks as if we're now going into a correction for the stock bond ratio. But if you bring it into a longer term perspective, you can see that we broke out of a consolidation to the upside. So this longer term version of this chart indicates that the longer term uptrend of stocks versus bonds is still in favor of stocks. However, there is room to the downside. You can see that we peaked in September, and now in October we declined a little bit, and there is room for more decline to say 4.5, maybe even 4.25, 4.30, and it still wouldn't hurt the uptrend in this stock bond ratio. And then on to sector rotation, longer term sector charts. Here's the monthly RRG for the 11 S&P sectors. And it's interesting to see that there's actually only 3 tails that are pointing into that northeastern direction that we like so much. It's communication services, it's consumer discretionary, and it's technology. Lo and behold, these are the, let's say, large cap growth areas. I did a piece on that not too long ago. You can look that up on my blog. But it's interesting to see that these long-term trends are actually underscoring, I guess, a positive undertone for the market, despite the weakness that we've seen recently. I'm actually pretty I think it looks pretty good when consumer discretionary, technology, and communication services are moving into that top right-hand corner, especially when it's combined with utilities and healthcare and staples all moving in the opposite direction. So these are the defensive sectors. From a longer term perspective, these defensive sectors are getting out of favor. That is a bullish sign for the market. That is underlying strength for the market. Forget about, well, don't forget about it, but please remember, this is a long-term analysis. Within these months that we're looking, there is definitely a lot of room for movement on a daily or even a weekly scale. But you got to keep in mind the longer-term perspective, the longer outlook for these markets, and I think it should give you a better perspective, a better framework on how you need to approach those markets. So when I see a rotation like this with defensive markets getting out of favor and more growth-oriented markets getting into favor, even though they are kind of declining in price, it would stop me of making a massive bearish bet on the market as a whole. Does that make sense? I think that is probably the way you need to look at this. So this for the longer term rotations on the various sectors: tech, discretionary, communication service going the right direction. We've got energy here way to the right inside the weakening quadrant. This one still has a lot of possibilities to turn back up and complete the rotation on the right hand side, being in line with the bullish outlook for the energy sector as a whole. Now let's take a look at these individual charts, these long-term monthly charts for each individual sector. Starting off with communication services. As you can see, we are running into resistance around that 230 area, but it's still definitely an uptrend, higher highs, higher lows on these monthly bars. So despite the fact that we've seen some hesitation over the last, this is 4 months already, this is still a pretty strong outlook from a price perspective for communication services to move higher. It's actually underlining what we just saw on that RRG. We go to consumer discretionary, a little less pronounced as it was with communication services, but I believe that we can still call this an uptrend. Here's a low, here's a monthly high, here's a low, here's a new high, and we're still at a higher, potentially higher low. We don't know yet where it's going to come, but unless it breaks below, let's say 1,050, this uptrend remains intact. Would I have liked to see this market to stop at 1230? Yes, of course, but it didn't do that. That doesn't immediately break the trend. It's just going a little further down than anticipated, because obviously this previous high was anticipated as a new support level. It didn't work like that. Trend is still higher, and I think that we need to find resistance 1375. And as I said, support probably, you could even argue that we're at support here, but that's a little bit of, I don't know, maybe fantasy. Nevertheless, trend is still going up, price trend. Here is staples. This is one of the defensive sectors, and this is a downtrend. If you look at the monthly bars now, so here's a high, here's a lower high, here is a low, and we broke below that one, so that's now a series of lower highs and lower lows. By definition, that's a downtrend. We're resting at support. We're resting at major support, I need to think. So it's 690 is a very important support level for the consumer staples sector. If that breaks, we very likely will get an acceleration lower in staples, and staples is defensive. If that goes lower, I think that should be taken as a good undertone for the market as a whole. The upside is very limited. So this previous low here, what's that? Around 740. I think that's going to be the resistance level to watch for the consumer staples sector. Here's energy. That's an interesting sector because it's pushing and continues to push against its all-time highs. The trend is definitely up. Look at higher highs, higher lows. Again, we tested the range, and that's why I just told you this. I'm not a big fan of pinpointing support and resistance levels at exactly a previous high and low. I think much more in terms of ranges and areas. And I think the area here is showing up between, let's say, 715 and 725. There's a little spike here that goes to 738, but 720, 725, that's the area I'm watching. That's a heavy overhead resistance area. There's a lot of supply expected there. If that can be taken out, that would be a very bullish sign for the energy index. And remember where XLE is trading on the RRG. It's inside the weakening quadrant, but it's started to turn back up. If we take out that resistance area on the upside, I'm pretty confident that that tail, that relative tail, can actually be pulled back up before it hits the lagging quadrant and bring energy to the top of the board again. Support coming in, there's various levels, but I picked it here around 580. So here's financials. That is sideways. Look at where, lower high, and we got higher lows coming in. This one's, even the low of last month is above the prior low. So this is a sideways move. Expected to continue sideways. Not massive, not a lot going on in the financial sector from a longer term perspective. Now here's healthcare. This is another defensive sector. That's another defense sector. And we are actually falling back into the channel. We broke out, we rallied, and then you've got this massive kind of, sideways movement. Maybe you could even draw a little, I'm watching it right now, I could even draw a little diamond formation in here. But what I'm always watching here is when you have such a pretty pronounced channel and you're dropping back into it, that is usually a very negative sign. We're getting out of that. Let me annotate that diamond for you. 1 second. So here's a updated annotation, and I actually sort of shadowed this upper boundary. But so there's a couple of things that I'm watching here. First of all, we drop back into that channel. Usually my kind of rule, I don't think I've ever saw it written down somewhere, but my observation is that when a market breaks out of an already rising channel, that's usually very good and it leads to an acceleration. That's what we saw here in the healthcare sector. But when it subsequently gets back into the channel, that's usually a very negative signal. It very often leads to a test of the lower boundary of that former channel. And in this case, that would mean currently 1340 for the healthcare index. But what I just noticed is that this is potentially can be seen as a diamond formation. Diamond formations are not very common. They are actually very rare, I believe, but I can see this as one. I believe it fulfills all the requirements as described by my good friends Edwards and McGee. If you haven't read that book, please do so. It's old, it's written somewhere in the 60s, maybe even earlier, but it's still so valid. And it's chart reading in its purest form. And what I'm doing here with these monthly charts is trying to apply that information, that knowledge to these charts as they are showing up today. And what we see here is that we broke out of that diamond formation, and that is usually a negative sign. It's a reversal sign, and it's pointing to lower prices for healthcare. Again, we saw that with staples. We're now seeing it with healthcare. Those are defensive sectors. Defensive sectors that are breaking down, they're showing a negative price impact or expected negative price impact. I think usually that is a good sign for the market as a whole, or at least it's definitely not a sign for an upcoming massive decline for the S&P 500. If you look at industrials, there's something interesting going on in industrials. A couple of months ago, I annotated this chart here with this, I now sort of shaded that line. There was a neckline from a potential head and shoulders continuation formation. I think that formation is now void. We rallied a little bit, couldn't maintain the break above the highs, and we broke back below the neckline. That is not a good sign. So for the industrial sector, the outlook is not too good. We're resting at support here around 810, 815, but the upside is now limited to, I don't know, it's going to be 885, 890, 900. This whole area is full of resistance. So the upside potential for the industrial sector is not very good. And I did a sector spotlight on seasonality on Monday. And I explained that industrials actually expected to be one of the strongest sectors for the month of November that we're currently starting. From a longer term perspective, that's going to be very difficult, but it's very well possible that you will see a strong November, because imagine if this rallies to 850, 860, 875, we will still have this sort of negative constellation. By the way, the longer term trend, I've still labeled it up, but it's on the verge, it's on the edge, because when it breaks below this low here, then it's definitely going to not be an uptrend anymore. It's not going to be a downtrend because there's no lower high yet, but it will go into a sideways move. And then we have information technology. We tried to break higher, didn't work, so that area around 3100 is still our most important resistance level to watch. Downside, there's still a bit of risk here because 2660 is the first level that we can see where there is serious support coming in. Because of the strong rally, because of the strong move, the uptrend is still there. Higher highs, higher lows are still there, and we need a lot of downside to bring technology back into a downtrend on the monthly bar chart. So I don't think there is a risk of that happening anytime soon. For the time being, technology is still in an uptrend, pushing against 3100 if we can take that out. I don't think it's going to happen this month, but if we can take that out, that'll be a very good sign for the market as a whole. And then we have materials, and materials is definitely sideways. You can see a very pronounced trading range with 470 here on the lower end and about 540 on the upper boundary. Again, this is probably going to bounce back and forth in that range. When we take when we get a breakout to the downside, the next target is around 420. If we break out to the upside, it's somewhere 580. I think is a very reasonable target. 575, 580 is a reasonable target area in case of an upside break. But we're closer to the downside than we are to the upside. Respecting support and resistance, I think it is more likely that we will see a little bounce higher in the coming month. And then here's real estate. I wrote actually the title of the first sector spotlight of this week was that seasonality is dropping a big bomb on the real estate sector, and you can see why here. This is the monthly chart, and we're just breaking out of this consolidation lower, and we actually, so here my cursor is where we closed. So that's, what is that? 207.55, well below 210, and I think the risk is definitely there to 180. This sector is now definitely in a downtrend, and I think probably the riskiest sector in the S&P 500 towards the end of the year, probably. And then we have the utility sector. That's the last one. And look at it again. So this is one of these defensive sectors. We saw staples, we saw healthcare, and here is utilities. A break below the trend channel. This is not a very good chart. During the month, we rallied towards the high end. So we actually closed higher, but look at the low here, and now where we closed. So we're bouncing back up, but the upside is littered with resistance. There is a first level right here, which is this previous low. That's 306, 307. But I think that the more serious resistance area is where these lows are coming in and where they're where they are coinciding with the former rising support line that's now going to act as resistance, and that's the 320 area. Nevertheless, the upside for the utility sector is very limited, while the downside is wide open, as you can see. And that leaves us with only one chart left, and that's the S&P 500 itself. And let's bring it right away. That is still an uptrend. Higher highs, higher lows. The S&P 500 needs to break below, I would say, 3,800 to put in a new low on a monthly chart. That is a lot of downside. I don't think it's going to happen anytime soon, but there is always a possibility. The upside's getting a little bit limited, so we're in sort of a doldrum doldrum phase for the S&P 500. I think that the old support level that we broke, that was 4,200, 4,300, is now going to act as resistance. That is an important barrier on the next way up. What's more important to find is where will the market put its new low into place. It could be the 4,100 that we saw as a low last month. Maybe it goes a little lower. The most important thing is that we will see on this monthly chart, so this is going to take a while, folks, this is not going to happen overnight, where we will put in a new low. Maybe it's already there, maybe not, but we need to see a new monthly bar with a higher low than the previous bar, and like how a low shows up, how that should look. And only when that is in place we can kind of call that new low. For the time being, I'm cautiously optimistic for the S&P 500 that we can either hold here, maybe dip a little lower, but the uptrend is still there, and we got to respect the support and resistance levels. And that leaves nothing else than the table that you're used to wrap up this show and discussion assessment of the monthly trends. I'm not going to go over all these numbers here. You can pause the video and just look at it. There's a ton of changes, and that is because there's a 2-month hiatus period that so this is the changes that occurred in 2 months actually. And the levels have been adjusted. So here you can see where the upside potential and the downside risk is, and how last month, and I think that's the only thing that I want to say about this chart, about this table, is that it's interesting to see that staples and utilities, two of the defensive sectors, were actually showing outperformance over the S&P 500. So that indicates that this was a risk off month to a degree, because the longer term trends are definitely the reverse of what we saw last month. And then communication services and technology were outperforming the S&P 500, and that is kind of underscoring the analysis, the assessment of large cap growth stocks still doing a really good job. Anyway, that's it for the month of October. We're starting November. This was the second Sector Spotlight of this week. Thank you so much for watching. And please remember, Sector Spotlight is available on demand on the StockCharts YouTube channel, usually recorded and uploaded on Mondays. This is an exception because the end of the month. And as usual, feel free to share your thoughts and ideas in the comments below the video. Looking forward to seeing you again at a new episode of Sector Spotlight next week on Monday. Same time, same place.